In today's video, I want to break down a series of warning signals that are now flashing across global financial markets. Individually, each signal is concerning, but taken together, they point to something far more serious: a structural debt storm forming beneath the surface. This isn't fear-mongering, it's not prediction for prediction's sake. These are data points, policy decisions, and market movements that are already happening, and they deserve a clear and calm explanation. So let's take a closer look at what 2025 is signaling, and why governments, central banks, and markets are quietly repositioning themselves. Firstly, the global debt problem is no longer manageable. Let's begin with the core issue. Global debt has reached levels that can no longer be managed with traditional tools. For more than a decade, interest rates were held near zero. Governments borrowed aggressively, confident the debt was cheap and serviceable. That era is over. The world now carries over $315 trillion in debt. Debt servicing costs have doubled in the last 2 years, and major economies are rolling over short-term debt into much higher interest rates. This means the cost of simply maintaining government debt is rising rapidly, squeezing budgets, reducing flexibility, and increasing the risk of a funding crisis. Let's look at some warning signals. Warning signal 1, the bond market is straining. The first major warning signal for 2025 is the bond market, where governments borrow their money. We're seeing volatile yields on US, UK, and European bonds, weak demand at government debt auctions, foreign buyers stepping back, higher yields demanded by markets to compensate for risk. When the cost of borrowing rises while debt itself is rising, governments face a double blow. This is one of the more reliable indicators of future instability, because when bond markets lose confidence, everything else follows. Warning signal 2, liquidity is drying up. The second warning signal is liquidity, the ease with which money moves through the system. Today, liquidity is tightening across treasury markets, bank funding channels, repo markets, and corporate credit markets. We're now seeing early signs of a system that is becoming less flexible, less liquid, and more prone to sudden shocks. Now, liquidity doesn't disappear all at once. It evaporates slowly, then suddenly. Warning signal 3, consumer and business stress is rising. The debt storm isn't just a government problem. It's showing up on main streets, in households, and in businesses. Higher mortgage rates, rising credit card balances, slowing retail spending, lower investment by businesses, and job markets softening in several developed countries. These aren't isolated data points. Together, they create an environment when even a small shock can have large ripple effects. Warning signal 4. Central banks are concerned and quietly repositioning. Central banks won't openly admit it, but their behavior is telling a story. Slowing or reversing tightening cycles, increasing emergency liquidity lines, stress testing banks more aggressively, preparing for lower growth scenarios, and holding behind-the-scenes discussions on financial fragility. When central banks change behavior quietly, it's usually because they see something ahead that the public hasn't fully appreciated. So what does this mean for 2026? This debt storm does not automatically mean collapse, but it does mean markets will become more volatile, governments will face tough decisions, borrowing will become more expensive, growth will weaken, and the system will become more fragile. Have you not noticed this, even today? Understanding these signals early is essential, not to create fear, but to stay informed and aware. Now, if you found this breakdown useful, please like and subscribe. It genuinely helps the channel to grow. If you want to understand the other side of this story, the future of money itself, watch my recent video, The New Global Money System. You'll find it linked on the screen now. As always, thank you for watching and see you in the next video.